Welcome back to Biz Intel, our weekly briefing that looks beyond the surface to examine the quiet forces reshaping the global economy and technology. As 2026 begins, a fundamental question comes into focus. Who truly holds power in the AI race? Is it the model developers or those who control the chips, electricity, capital, and infrastructure required to run AI at scale? In recent weeks, NVIDIA has signed major agreements tied to AI operations and chip deployment. xAI has been expanding its data centers while moving to secure independent power sources. Meanwhile, Brookfield, traditionally an infrastructure investment giant, has gone a step further, announcing plans to provide AI services directly on its own platform. On the application side, OpenAI is preparing voice-centric AI products, while Microsoft has acknowledged that many enterprises have purchased Copilot but are struggling to use it effectively. Taken together, these developments suggest that the AI race is moving away from promises and demos and into a phase where infrastructure, energy, capital, and real-world execution are the decisive factors. AI's power shift, code is no longer king. When AI power lives on the ground, not in the cloud. In late December, NVIDIA announced a deal worth roughly $20 billion with Grok, a startup specializing in chips designed for the operational phase of AI models. Rather than acquiring the company outright, NVIDIA chose a more flexible structure, licensing Grok's technology and absorbing much of its engineering talent, while allowing the company to continue operating in a leaner form and maintain its existing service platform. Grok is known for chip architectures optimized for real-world AI deployment after training is complete. This segment is growing rapidly as AI applications proliferate and operating costs become a critical competitive factor. AI operations are increasingly forming a distinct battleground of their own. The agreement enables NVIDIA to strengthen its position in this space without pursuing a full-scale merger or acquisition. At the same time, NVIDIA has continued to emphasize the concept of the AI factory, an approach that treats AI systems as an integrated industrial production line encompassing chips, networking, software, and operating infrastructure. In this model, chips are merely the starting point of a much larger system. At the physical infrastructure layer, Elon Musk's xAI has continued expanding its footprint in the Memphis area by acquiring another large-scale data center, bringing its total facilities there to 3. The project aligns with plans to deploy hundreds of thousands of graphics processors to support the training and operation of large-scale AI models. Artificial intelligence consumes enormous amounts of electricity. To meet this demand, xAI is also investing in its own power generation at a time when data centers are increasingly constrained by the limits of local power grids. The combination of on-site data centers and dedicated power sources reflects a growing trend toward tighter integration between AI and energy infrastructure, particularly for projects operating at industrial scale. While technology companies are building infrastructure directly, traditional infrastructure investors are also redefining their roles. Brookfield, a major investor in real estate and data centers, has announced plans to provide AI computing services directly through its subsidiary, Radiant. The firm has committed tens of billions of dollars to AI infrastructure, aiming not only to own land and facilities, but also to deliver computational capacity to clients. NVIDIA is involved as a technology partner supporting the development of server clusters built around its graphics processors. This move illustrates how infrastructure funds are expanding beyond the traditional model of leasing physical space and instead moving deeper into the AI value chain. Not only investors, but even long-established technology companies are facing mounting capital pressure as they scale AI infrastructure. Oracle, as it commits to building large data centers for AI partners, is grappling with the high costs of acquiring chips and constructing facilities. In this context, discussions have emerged around using AI chips themselves as collateral for financial instruments. If adopted, AI chips would no longer be viewed solely as technology hardware, but as assets that could underpin lending and capital-raising structures. Alongside corporations and investors, some governments are beginning to approach AI as an issue of infrastructure and sovereignty. Indonesia has launched Sahabat AI, an open-source large language model for Bahasa Indonesia developed with the participation of international technology partners and academic institutions. The initiative comes amid growing concern among countries about dependence on foreign-controlled AI models, particularly as AI becomes embedded across economic, administrative, and social systems. As chips, electricity, and data centers become the foundation of the AI race, major technology companies can no longer stop at simply expanding infrastructure. The next phase lies in reshaping corporate strategy through acquisitions, mergers, and organizational restructuring at the enterprise level. Buying technology, buying talent, buying time. In late December, Meta announced the acquisition of Manus, a Singapore-based AI startup, at a valuation exceeding $2 billion. Just months earlier, Manus had been valued at around $500 million in its most recent funding round, backed by several international investors. The company develops AI systems capable of autonomously executing complex chains of tasks rather than merely responding to isolated prompts. This approach has attracted growing attention as AI is expected to move beyond conversation and into practical workplace support. The deal comes as Meta recalibrates its AI strategy and restructures its internal organization. Meta is not alone. In recent months, other major technology companies, including Microsoft, Amazon, and Google, have increasingly favored arrangements that absorb talent and technology rather than acquiring entire AI firms outright. This model allows companies to rapidly strengthen technical capabilities while reducing legal risk and shortening deployment timelines compared with building systems from scratch. As a result, acquisitions today are no longer just about scaling up. In many cases, they are simply a way to buy time in the AI race. On the enterprise product front, Microsoft faces a different challenge. Although Copilot has been widely embedded across Microsoft 365 offerings, many corporate customers admit their employees are not yet using AI features effectively in day-to-day work. In response, Microsoft has begun investing heavily in training programs and deployment support, treating user education as an integral part of selling and scaling AI-enabled products. Meanwhile, Apple continues to pursue a cautious approach to AI. The company has delayed several major upgrades to Siri and has not announced AI investments on the same scale as its rivals. This strategy runs in parallel with Apple's preference for maintaining large cash reserves and tightly controlling the pace of new feature releases. Strategic adjustments by big tech are also extending beyond software and services into AI-dependent sectors such as transportation and urban mobility. Waymo continues to expand its robo-taxi operations and is reportedly discussing new fundraising plans, while Uber and Lyft are closely monitoring the long-term impact of autonomous vehicles on their traditional ride-hailing business models. At the same time, Uber is negotiating the acquisition of Spot Hero, a parking reservation platform, as part of a broader effort to expand its mobility ecosystem, particularly as autonomous vehicle usage is expected to grow. By contrast, Tesla has warned that vehicle deliveries may decline in the short term, even as it continues to emphasize long-term plans centered on autonomous driving and driverless transportation services as core strategic pillars. As major technology companies simultaneously adjust their strategies through acquisitions, talent absorption, and organizational restructuring, the focus of the AI race is shifting. The central question is no longer who owns the best technology, but how artificial intelligence will be deployed and operated within existing business models. AI leaves the lab and enters the business model. One of the biggest challenges facing AI at this stage is no longer model capability, but how users actually interact with it. Both OpenAI and Microsoft have acknowledged that many users, including enterprise customers, are failing to extract full value from AI tools they are already paying for. The problem is not that AI is too weak, but that users do not yet know how to use it effectively. To close this gap, OpenAI has rolled out free training programs focused on prompt design and workflow integration. The goal is to help users move from experimental use toward applications that deliver tangible value in everyday work. Alongside these training initiatives, OpenAI is preparing to launch a new AI model centered on voice-based interaction, while reorganizing its internal structure to prioritize audio processing capabilities. The model is designed to enable more natural conversations and support screenless interactions. Voice-driven AI devices under development by OpenAI are expected to unlock new use cases, particularly in environments where keyboards and screens are impractical or unavailable. In the enterprise segment, xAI has introduced Grok for Business and Grok Enterprise, aiming to embed AI more deeply into organizational workflows. These offerings support integration with internal data storage systems and add features related to governance, security, and billing. Scaling AI in corporate environments requires more than a strong product. It also demands sales capability, deployment support, and long-term customer relationships, all of which play a critical role in the pace of commercialization. Beyond the major players, the AI startup ecosystem is beginning to show clearer signs of revenue traction. More than 25 AI startups have now surpassed $100 million in annual revenue, indicating that AI is gradually moving beyond experimentation and into real cash generation. Even so, most of these companies are still in scaling mode, struggling to balance infrastructure costs, talent expenses, and revenue growth without a stable equilibrium. At a global level, AI monetization is heavily shaped by user geography. The majority of OpenAI's users now reside outside the United States and Canada. Markets such as India and Brazil contribute large user bases, but generate far lower average revenue per user than developed economies. As a result, user growth does not automatically translate into revenue growth. Wide disparities in spending power across regions make international expansion far more complex. While OpenAI expects its global user base to continue expanding rapidly in the coming years, improving revenue per user in international markets will be a decisive factor in meeting long-term financial targets. As AI begins to generate revenue, the next inevitable pressure point will come from capital markets, where investors will seek liquidity, exits, and clear answers to a critical question: can cash flows from AI ultimately justify the ever-growing scale of investment behind it? Capital markets at a moment of reckoning. After years of rapid expansion, private markets are entering a period of acute liquidity strain. An estimated $3.7 trillion is now trapped in venture-backed private companies that have yet to go public. Over the past 12 months, total liquidity generated through IPOs, mergers and acquisitions, and secondary markets has reached only around $307 billion. A pace of capital return that lags far behind the scale of investment deployed. The money is still in the system, but the exits are narrowing. Liquidity is increasingly concentrated in a very small group of large companies. Secondary transactions revolve around just a few dozen names, while the vast majority of remaining unicorns face an ill-defined or non-existent market for their shares. This dynamic is widening the gap between paper valuations and the ability to realize profits in cash. The NVIDIA Grok transaction offers a clearer view into how capital markets in the AI sector are now operating. While the deal enabled founders and some early investors to achieve partial liquidity, its structure, combining technology licensing with talent absorption, has complicated the long-term interests of many traditional investors. Once core engineering teams depart, the remaining startup often continues at a much smaller scale. In response, venture capital firms are re-examining governance and shareholder agreements, seeking to limit risks in scenarios where technology and people, the two most valuable assets, are transferred without a full acquisition. In public markets, 2025 closed with an increasingly sharp dividend. Companies tied to AI infrastructure and hardware supply chains continued to attract investor attention, while many traditional software firms came under pressure as expectations around AI began to weigh directly on their core business models. Some technology stocks posted strong gains over the year, reflecting market confidence in AI's long-term role. Others saw share prices fall sharply from their peaks as the pace of AI deployment and real-world business performance failed to keep up with early expectations. The market is still betting on AI, but the bets have become more selective. As capital grows more cautious and exits remain constrained, the AI race is no longer just a story of technology or business. It is increasingly pulling in broader debates over policy, regulation, and the role of the state, leading us into the next arena: AI, politics, and power. AI moves from code to policy. The federal government has issued executive actions aimed at limiting individual states' ability to craft their own AI regulations, while simultaneously accelerating permitting processes for large-scale data centers. These decisions have a direct impact on the pace of AI infrastructure expansion across the country. Artificial intelligence is no longer confined to laboratories. It has become a policy issue. Alongside regulatory moves, major technology companies have increased their presence in political life. Significant financial contributions to funds linked to the federal administration have been recorded, underscoring the increasingly close ties between the AI industry and the policy environment. While the United States focuses on domestic regulation and policy debate, China continues to push forward its strategy for AI chip self-sufficiency. Byren Technology, a domestic AI chip maker, completed an IPO in Hong Kong, posting a strong first-day surge and raising hundreds of millions of dollars from capital markets. Alongside Byren, Baidu has spun off its chip unit Kunlunxin for a separate listing, while More Threads has moved ahead with an IPO on Shanghai's Star Market. These developments show how China is leveraging domestic and regional capital markets to finance the construction of a homegrown AI chip ecosystem. Chips are technology, but in this context, they are also geopolitics. Beyond IPOs, Chinese technology companies are continuing to explore ways to reduce dependence on foreign hardware and models. DeepSeek has announced new training methods designed to lower computational resource requirements, while ByteDance is simultaneously preparing to acquire advanced AI chips and experimenting with domestic alternatives. This dual-track approach reflects an effort to balance immediate access to existing technology with the development of long-term capabilities amid ongoing geopolitical uncertainty. As AI becomes more closely tied to economic growth, economists have begun to quantify the impact of AI-related spending on GDP. Estimates suggest that capital expenditure on AI has contributed a significant share of recent U.S. economic growth, highlighting AI's role as a macroeconomic driver. This also implies that fluctuations in the AI investment cycle could have broader spillover effects, not only for the technology sector, but for the economy as a whole. As AI becomes a variable in policy and geopolitics, this race is no longer decided solely in laboratories or boardrooms. All of these currents converge in the final section, where the broader picture of AI at the start of 2026 begins to come into focus. Who is accelerating and who controls the game? When all the movements examined in this piece are placed side by side, one reality becomes unmistakable. AI has moved beyond being a software race. It is becoming a full-fledged industry, one where chips, electricity, land, capital, supply chains, and policy matter just as much as algorithms. NVIDIA is no longer simply selling chips, it is shaping the operational architecture of AI itself. XAI is not just training models, but building power plants to run them. Brookfield is not merely owning infrastructure, but selling computing capacity directly. Big tech is not only innovating, but acquiring talent and time to avoid falling behind. And at the highest level, AI has become a variable in GDP growth, economic policy, and geopolitical competition. What unites all these shifts is a common theme. Advantage in AI no longer comes from a single breakthrough idea or model, but from the ability to operate a large, capital-intensive system over many years. The race is accelerating, yet its foundations are still being laid, not yet hardened, not yet stable, and under constant pressure. This helps explain why capital continues to flow into AI even as markets grow more selective. Why big tech is investing aggressively while simultaneously building defenses. And why not all companies stand on equal footing in this race. Some are clearly benefiting, while others are being forced to adapt faster than their own capabilities allow. In this context, CES 2026 is more than a technology showcase. It is a stress test, a boundary between two phases of AI. The era of demos and expectations, and the era of physical products, factories, robots, and autonomous systems. What is presented will no longer be judged by its wow factor, but by a harder question. Can it be deployed at scale, operated reliably, and generate real economic value? Amid tens, even hundreds, of billions of dollars in investment, the group under the greatest pressure to adapt may not be corporations or investors, but people themselves, from engineers and office workers to startup founders and employees in industries directly affected by AI. As we move deeper into 2026, the most important questions are not only for AI companies, but for everyone surrounding this ecosystem. For investors, where is the line between betting on the future and becoming trapped in a prolonged capital cycle? For businesses, is AI a productivity tool or a fixed cost that grows increasingly difficult to control? And for the broader economy, will AI become a sustainable engine of growth or just another massive investment cycle that leaves a heavy burden behind? If the opening chapter of AI in 2026 is a story of chips, capital, and infrastructure, the next chapter is likely to shift toward AI in the physical world. Robots, autonomous vehicles, and smart factories, where AI no longer lives on screens but begins to directly shape productivity and everyday life. Yet after all of this, the central question remains unchanged. When does AI stop being a story of investment and expectations and start becoming a story of profit, efficiency, and real-world validation? Perhaps not immediately, but 2026 will give us the first clear signals.